so many people have invested in China, and for a lot of reasons. It has a $1.4 billion consumer market, 1.4 billion consumers in that market, and people have invested in things like Tencent and Alibaba because they wanted to get rich from this growing market that is becoming more developed as time goes on. But there is only one problem. People forgot that this is not a pro-business kind of country, even despite the fact that you see a lot of factories and people starting to do more advanced things. You have to remember that China is a communist country, which means the government controls everything, and then if there's something they don't like, they put an end to it very, very fast. And so sadly, a lot of people have invested in China. They thought this is the next new thing, very exciting. And you even have people like Jim Rogers. He's a world-renowned investor, and he's touting in China, saying people should invest in it. But here's the problem. That would be fine if there was a predictable rule of law kind of market that we get in China. But instead, we're getting an autocracy, a totalitarian state that now is starting to crack down on some of these businesses in China. And there's a reason why we're seeing Tencent, it's gone down 50%. We're seeing some, like a Chinese secondary school program is down 95%. I'm not laughing at people who lost money. It's just that this is all predictable, though. What happened is that some of these companies in China have become so big that the Communist Party sees them as an alternative source of power, and they don't particularly like alternative sources of power in a communist country. So they're putting a stop to this, and with Didi, which is a company similar to Uber. It might even be stolen technology from Uber, but anyway, they handicapped that company. They said, hey, can't add more users. Alibaba, they having a problem with Jack Ma because Jack Ma, despite the fact he's a member of the Communist Party, they don't like the fact that young people are starting to look up to Jack Ma instead of the communist honchos. So what this means for you, though, and I made a warning about this a year ago. I said a year ago that you should not be investing in these communist Chinese companies, and sadly a lot of you did not listen to me. Say, hey Michael, it's still a great market's going up in China, great place to invest my money. But the problem is that China is a very unpredictable place, and right now the government is really trying to crush the stock market over there. They don't really like all this capitalism going on. And the other thing is, you might not believe it because you might not believe one thing, that for one thing, it's actually illegal for foreigners to own Chinese companies. So you might think, well, how did I invest in Tencent or Alibaba? That's actually an interesting question, and I know the answer to that. There's a thing called variable interest entity. So what happens is that Chinese company like Tencent, they set up like an office in the Cayman Islands, and they create a variable interest entity. So when you buy Alibaba, you're not really buying the Chinese company, you're buying Alibaba, the Cayman Islands company that kind of owns shares somehow in the real Alibaba. And so that means that you actually have 3 times the risk, because you have the risk of China doing something crazy. It just, maybe they crack down on Alibaba, do something unusual. Then you have the risk of the Cayman Islands. Yeah, well, it's a low risk. It still is a risk. What if Cayman Islands, what if they impose a massive tax, or just somehow don't allow this kind of deal to go through, or I don't know, it could be a million unknown tail risks. And then there's the third risk, which is that it's actually very unpopular now for Americans to invest in China. So Congress could put additional auditing and reporting requirements for these Chinese companies, and that could result in them being delisted, which would mean that you own a highly illiquid investment that would be very, very hard for you to sell. And if you were to sell, you probably would lose a lot of your money. And even if you can sell, like as an example, these Chinese stocks that are still on the market today, a lot of them are down substantially, 50%, sometimes 95%, as I pointed out. And I actually believe that this is not a dip to buy. A dip to buy makes sense if you know what your risk is, and it makes sense. But we're in a situation where China doesn't care if you lose money, and they don't even care if you're mad at them. or if you don't want to invest in their country anymore because they're trying to kick foreigners out of their country. And if that means also pushing foreigners out of their markets, they're okay with that. They don't really care. So now is the time, if you have Chinese stocks, to lower your risk, start dumping them, even if you believe in them, because the thing is, you're investing in a place where the risk is too unknown, and when something has too much unknown risk, it's definitely not the best place to be. So that's my advice. Of course, I don't give financial advice. I'm just saying what I would do. I would be selling if I had owned these stocks, but I probably would have sold it a lot sooner than now. But anyway, get out while you still can. So let me know what you think in the comments below, and subscribe, and I'll see you in the next video.